What made headlines in 2023? Catch the real impact of the year's top stories. Watch the 2023 year-end specials only on the Business Standard Morning Show from 22nd to 29th December.
Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 28th of December 2023 and here are the questions we will be answering today. Why is Paytm pivoting away from lending? What did 2023 reveal about the future of AI? Will the laggards of 2023 turn around next year? And what is the new EU pact on migration? Paytm's parent company 197 Communications has reportedly laid off over 1,000 employees over the last few days. Now it is realigning its various businesses to cut costs and turn profitable again. These layoffs also come on the heels of Paytm withdrawing from small ticket consumer lending after RBI's clampdown on unsecured loans. In today's In Focus segment, Ayush Mishra finds out why Paytm is pivoting away from lending.
Paytm has reportedly laid off more than 1,000 employees across various departments. The fintech major is overhauling its operations to achieve its first net profit since listing in November 2021. It has lost about 70% of its market value since it brought its IPO in 2021. The recent job cuts will affect over 10% of Paytm's total workforce, and news reports claim that a large chunk of it was from the lending business. The layoffs follow recent strategic shifts at the company. It is shifting away from small ticket consumer lending and has terminated its buy now, pay later lending segment on the UPI platform. It all came after the RBI's regulatory clampdown on unsecured loans. On 6th of December, the company said that it would pull out from Paytm Postpaid and take a cautionary approach towards small ticket loans. The company used to disburse loans under 50,000 rupees under Paytm Postpaid. The fintech major will now shift its focus to disbursing higher ticket personal and merchant loans to lower the risk. Paytm has partnerships with 7 non-banking financial companies for its lending operations.
Most of the lending of Paytm was in the below 50,000 bracket, and with the tightening of the consumer lending rules, curves brought in by RBI, Paytm didn't have a choice but to curtail this part of the business. This was an important growth catalyst for Paytm. Therefore, we saw a sharp cut in the stock prices. However, Paytm is not completely moving away from lending. They would continue with the higher ticket loans, but they may not get similar sort of volumes or margins. So it's quite natural that they have to let go a large number of employees from this team.
Paytm recently said it was seeing good demand in higher ticket low risk personal and merchant loans. Merchant loans are extended to MSMEs as a business loan and they are not impacted because of the recent regulatory changes. There will be minimal or no impact on the take rate for these two categories. Helped by steady loan growth at its financial services unit, Paytm's revenue jumped 32% to 2,519 crore rupees in the second quarter of FY24, from 1,914 crore rupees a year earlier. Paytm's consolidated net loss narrowed to 291 crore rupees in Q2 FY24, from 571 crore rupees a year ago. In Q2 FY24, Paytm disbursed postpaid loans amounting to 9,010 crore rupees, marking an impressive 122% year-on-year increase. But loans below 50,000 rupees constituted 72 to 75% of the overall disbursements in this lending category for the September quarter. Consequently, the company's decision to issue fewer sub 50,000 rupees personal loans is anticipated to adversely affect its lending business. But at the same time, Paytm plans an expansion in the insurance and wealth management segments.
They now plan to grow big in the wealth management space. When we talk about wealth management, generally we think of high net worth individuals. But for every individual, whether it's big or small, the money saved and invested is wealth for them. And there's a huge gap in services in this space between what is expected and the services provided, especially in the bracket of 25,000 to 10 lakhs. If Paytm can effectively fill this gap, I'm quite sure that it will give them better profitability than what was envisaged earlier.
They seem to be looking at wealth management and they seem to be looking at insurance broking businesses. I would certainly say that wealth management is a cluttered market. I mean, there are already so many people getting into it or already got into it. The bank-led wealth management practices are much sort of stronger compared to the non-bank. The non-bank are also there. Some of them are very good service-oriented ones, but then they have to compete in that market.
So what can be the future course of action for Paytm?
One is to see, in this particular area, in so-called digital banking or digital service providing or digital distribution, financial products, I think disruption causes a major problem. You have to come out with something unique, come out with something different. Now, if you go into, let's say, any of the traditional businesses, there are already so many people present in it. So I would eagerly wait for Paytm, if they have a strong think tank and if they are considering, to get into a new kind of an environment altogether, then I'm sure they'll come out with something totally different.
Experts believe that Paytm will maintain its focus on merchant loans, specifically directed towards MSMEs as business loans. Given that these loans serve business purposes for small merchants, they are not significantly affected by recent regulatory guidance. At the same time, Paytm will keep on exploring various business models to enhance its profitability.
When asked about the recent layoffs, Paytm said that it was aiming to save 10 to 15% in employee cost with artificial intelligence-led transformations, and that it would result in a slight reduction in the workforce. Well, 2023 will be remembered as a year when people and companies started taking AI seriously. In today's year-ender segment, Kasturi Akhil sheds light on the key milestones in the AI industry and finds out what it may reveal about AI's future.
"2023 was the year of the rise of artificial intelligence. While the potential of AI is well recognized, this year, generative AI went mainstream, and people got to witness its transformational possibilities both globally and in India. Among other advancements, it was mainly OpenAI's ChatGPT that dominated the charts in 2023. A 2023 McKinsey survey of 1,684 participants reveals 79% of the respondents have at least some exposure to Gen AI, either for work or otherwise, and 22% of them are regularly using it for work. The application of Gen AI is highest among respondents working in the technology sector and those in North America. Global enterprises are also turning to AI integration. Generative AI startups attracted significant funding from investors worth over $26 billion in the past 5 years, the highest being in 2023 at $17.8 billion, according to global database management company Dealroom. Several noteworthy Gen AI initiatives have emerged in 2023, with Google unveiling Bard AI and Microsoft integrating ChatGPT into the revamped Bing. Adobe rolled out a range of generative AI-powered tools like Firefly for Enterprise to enhance marketing workflows and digital experiences. OpenAI also launched GPT-4. Google followed suit and launched Gemini, which is touted to be Google's most powerful AI model yet, even better than GPT-4. Meanwhile, India's Gen AI market is projected to surpass $17 billion by 2030, from $1.1 billion in 2023, expanding at a CAGR of 48%, Inc.42's latest report revealed.
The great thing Gen AI has done for AI in general is explain to people how powerful it can be. It's always been that powerful. But also with Gen AI, I think it has piqued the interest of a lot of CXOs. So earlier, when we used to go to a corporation and say, hey, we should do a transformation, we should do AI for so-and-so scenarios for your corporation, usually you will get some people are very excited. Some CXOs will be like, yeah, fine, it's not in my radar. But now it's the other way around. Now CXOs are coming to us and saying, how can you do something Gen AI in my corporation?
The prolific growth of artificial intelligence has also raised concerns over the ethical use of large language models. OpenAI, a leader in generative AI, recently faced internal dispute as co-founder Sam Altman and other board members disagreed on the right approach to AI development. It set the stage for a larger debate wherein some said AI development and commercialization should be sped up, while others insisted on proceeding with caution.
I strongly believe that you can't stop the march of technology. AI will have its own impact, not just on jobs, but the way we live, the way we interact, the way we understand reality, the deepfakes that's getting impacted, the way we do democracy, the way we do banking. All of this will get impacted so significantly. But again, as I said, that does not mean that the march of technology will stop, because once the genie is out of the box and we have very powerful models like LLMs out there, there'll be somebody or the other who will start using those technologies to build solutions on which there will be no oversight. So it's better that such technologies are built within corporate structures where there is oversight and where we can then quickly put in the required regulations so that there is ethical AI. In fact, even the question of what is ethical is also not a settled issue. But we can't hold the companies who are developing AI as responsible for that.
One of the landmark events in this space was marked by the European Union's agreement of the AI Act. It is the first comprehensive AI legislation in the world that aims to create a regulatory framework for ensuring risk mitigation, transparency, and accountability for AI development and deployment among developers and users. Meanwhile, in India, the center is looking to develop its own sovereign AI and build a computing capacity to help startups leverage its digital public infrastructure without needing to invest in the otherwise costly graphic processing units. India is home to more than 70 Gen AI startups, which raised more than $440 million between 2019 and Q3 2023, according to the Inc.42 report. Moreover, many Indian startups are foraying into building large language models for generative AI, some being specific to India. Some of these include Ola co-founder Bhavish Agarwal's Krutrim, Tech Mahindra's Indus project, and Project Vani, which is being developed in collaboration with Google. The year 2023 saw major AI breakthroughs, paving the way for increased deployment in 2024. While integrating AI in our personal and professional lives will require substantial investments in technology stack, it would also require a heightened awareness of the ethical concerns that were raised this year.
This year also saw equity markets staging a handsome recovery with benchmarks eyeing to close the year with double-digit gains. But pockets like private banks, metals and oil have lagged behind. Harshita Singh decodes the reasons for this and lays down the 2024 outlook for these segments.
Equity benchmark indices BSE Sensex and NSE Nifty are eyeing to close the current calendar year with strong double-digit gains. The two indices are up 18% each for 2023 so far. Sectorally, Nifty Realty, Auto, Pharma and PSU banks are leading winners with gains of 29 to 77%. On the flip side, the financial pocket including private banks, metals and oil and gas indices pale in comparison with gains of 11 to 15%. The high interest rates of 2023, analysts say, led to a slowdown for major economies including China, which is why metals underperformed. Cheaply priced public sector banks attracted more investor attention as compared to private peers. While the subpar performance in the oil segment was due to crude remaining elevated for most part of the year.
The first year of those interest rate hikes, we would see the loan portfolio of the banks getting repriced to the prevailing higher interest rates. And that would translate to better spreads and net interest margin for the bank. So that helps in better profitability. And in the subsequent periods, what we would see is even the deposit or the asset side of the banks would get repriced to those higher interest rate environment. And in that scenario, the spreads or the net interest margin of the banks tend to compress a bit. And that has happened in the last year. If you look at the metals landscape, in most of the commodities, almost 50% of the demand and supply is controlled by China. And China had a muted recovery over the last year, and the recovery or the growth from China was much lower than what the most of us anticipated. And therefore, the metal global demand was weak, and that translated to limited improvement in those metal prices.
For 2024, private banks are expected to make a comeback riding on rate cuts, firm credit demand, and inexpensive valuations. The trajectory for metal stocks hinges on demand acceleration in China, while there is uncertainty on the oil and gas bucket as crude prices may remain high, limiting margin gains. Thus, analysts suggest remaining selective on the latter two.
If I look at, if I combine the valuation comfort plus how those fundamentals are panning out, clearly the pecking order is the banks or the banks stands first. One, the reasonable valuation is quite reasonable compared to their long-term history, or even if we were to assess their fair value. So that there is a better margin of safety in that bank's pocket. The second preference could be for metal sector. As interest rate moderates, we could see some kind of pickup in the global growth, and that should benefit the overall metal prices. Private banks, from even from a bucket perspective, it looks quite attractive, even if we want to take that group as a cohort. But when you come down to oil and gas and metals, you have to be very selective.
Moreover, within the oil pockets, select stocks like those of OMCs have rallied this year, even as the oil index has lagged due to RIL's high weightage. Analysts at BOB Capital say these gains have largely captured the benefit of likely margin expansion, and there are limited triggers for a further rally in OMCs in the near term, as marketing margins will normalize with historical losses being largely recouped. Proximity to general elections also limits near-term upside to margins, they add. Thus, investors should bet on private bank majors and keep a cautious approach to metals and oil-related shares. Today, on 28th December, stock-specific action will continue and a new IPO listing of Azad Engineering will be tracked.
He's making plans for an early retirement. Business Standard.
the financial markets, let us now turn our gaze to Europe, which has recently agreed to a major overhaul of the bloc's laws on handling asylum seekers and migrants. Ayush Mishra tells more about it.
Member states of European Union and European Parliament have agreed to a major overhaul in the bloc's laws on handling asylum seekers and migrants. The new set of laws restricts the number of migrants that can enter Europe and enables quicker vetting of asylum seekers. It also mandates the formation of border deportation centers for holding illegal immigrants and allows for the faster deportation of immigrants whose asylum requests have been denied. In 2022, Europe hosted one-third of the world's refugees, rising from 7 million in 2021 to 12.4 million. Factors include the war in Syria, conflict in Ukraine, and increased migration from North Africa, especially to Italy and Greece. United Nations data for 2022 says that 159,000 people attempted the perilous journey to Europe, resulting in numerous casualties. After a decline in 2020, the flow of refugees and migrants has surged again. The aim of the agreement is to reduce the amount of irregular migration to the European Union. The reform includes provisions for faster vetting of irregular arrivals, the creation of border detention centers, and quicker deportation for asylum seekers whose requests are rejected. The agreement encompasses 5 key proposals from the pact. The screening regulation establishes uniform rules for identifying non-EU nationals on arrival. The Eurodac regulation creates a comprehensive database for more accurate detection of unauthorized movements. The Asylum Procedures Regulation accelerates asylum, return, and border processes. The Asylum Migration Management Regulation introduces a solidarity mechanism among member states and defines clear responsibilities for asylum applications. The Crisis and Force Majeure Regulation prepares the EU for future crises. The overhaul also contains a solidarity mechanism to reduce the pressure for southern countries that are seeing large numbers of asylum seekers arriving at their gates. Under the mechanism, some asylum seekers will be relocated to other EU states, while countries that refuse to take them in will make a financial or material contribution to those that do. The new system offers non-EU border countries 2 choices: accepting a portion of 30,000 asylum applicants or depositing a minimum of 20,000 euros per asylum seeker into an EU fund. This strategy aims to involve non-border nations in addressing the migrant challenge. Additionally, the pact aims to enhance the screening process to distinguish genuine asylum seekers, establish uniform rules differentiating EU and non-EU nationals.
I will achieve, I will fly high. I am the I in SBI. I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Between October 2022 and September 2023, a record of 96,917 Indians were arrested while crossing illegally into the US. Well, that is all for today. For more news, views, and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.